Why didn't they teach me this in an institution? I got 2 degrees from it. Why don't I know that? I always thought too, by the way, you had to be a rocket scientist or electrical engineer type to understand the math and numbers, so it intimidated me. So I never, no way, I'd stay away from it. When I saw what you're going to see tonight, it blew me away. As soon as I joined the business to actually expose it and put it out of business, and it turns out it was all the truth. As soon as we found out it was the truth, we just said, show us how to build a business and get out of the way. Show us what you're doing. And that was over for me all those years ago. Now, we've been retired for a lot of years personally, and we came back into this business again because associates of mine that we were in business 30 years ago, there are so many rule changes right now that none of you know about because we're not paying attention to it, that are going to steal your money if you don't do something about it real soon. And because of that, we get, excuse me for the vernacular, pretty pissed off. So ignorance is not a reason to stay broke. Would you all agree with that statement? Okay, ignorance doesn't mean we're dumb or stupid, it just means we haven't known. After tonight, when we give you the facts, you can't remain ignorant anymore. You've got a choice. And so we're going to give you those choices, but we're going to stimulate some thinking, and we challenge you to challenge us. How's that? So without any further ado, we have several speakers who are going to take over tonight and give you the presentation. And Shane recently got hurt and had surgery for his ACL, so he's just going to sit in that chair and carry on if you can. And Shane is what we call an MVP in our company, which is a pretty good spot. He was a teacher by profession and left Memphis, Tennessee to come back here and build a business along with his brother, which is pretty exciting. So having been a teacher for 3 years and coming here and being a leader in our company, I'd like to welcome Shane Young.
All right. Thanks, everybody. Thanks for being here. We're going to do a different thing with the video since I can't move around. I'm going to be taking a selfie the whole time, okay, because there's people watching. So hi to those that are watching on here. And you got that thing coming up, Brian?
Yeah.
So we're going to start off real basic, and we're going to stay basic the whole time because we've had people come into our briefings, and we've sat with people all the way, I don't mean to separate people into classes, but we've sat with truck drivers and service industry people all the way to doctors and CEOs, So does that change the way that we want to deliver a message about money? No, not at all, because it's the same rules, no matter who you're talking to, in my opinion. And so we're going to go over a really basic thing to start out with. It's what we believe are the 6 steps that are essential to be financially secure and independent. So we're going to go through them, and I guarantee you one thing you're going to think, right? I'm making an assumption. It's pretty common, though. Everyone's going to think, well, those are pretty obvious. There are 6 steps that are like, duh, you should have all these things in line. Just think of it, though, in terms of your own current situation, and decide 1 through 6. Take notes if you have them, so you can go back through them and see if you have every one of those 6 things lined up. We have the 6 steps. If you're missing one, then there is a pretty serious hole in what you're doing. And so I call it Swiss cheese finance. If you're missing one of the 6, then Swiss cheese has holes in it, right? So what we do for people is simply fill all those holes in just 2 ways. So of the 6 steps I'm going to show you, just keep in mind we only do two really basic things that fill all those holes. So we'll go through them. And if you have a question about any of them, or an objection saying maybe you think that step is not essential, or a question confusion about it, just ask, okay? So we'll go through them, and I'll point the camera at the board. So, Coach mentioned I used to run a nonprofit corporate. Well, I still run a nonprofit organization. That's what I did for 3.5 years in Memphis. I still run it, founded it, and never thought I'd be in this business until I realized that I can't make my financial dreams come true through the nonprofit world. It's just kind of a reality. So you're able to do a lot of different things with what you want in life through this business. So let's go through the 6 steps. Number 1 is increase cash flow. I'm trying to see if it comes through. There we go. Increase cash flow. So how many people would like to increase cash flow? Everybody? Michael, you don't want to increase?
Yeah, I'm sorry.
Okay.
Right.
No, I'm just messing with you. We're a participating crowd, all right? So so if you guys ask me a question, you expect me to answer it, right?
Yeah.
So I expect you all to answer the questions too. So increase cash flow. This is one of the most obvious ones when you first look at it. There's really 2 ways to do that, though. One is in my opinion, the easier one is just to make more money, right? That's one way to increase your cash flow. The other way to do it is the hard way, and that's the way most people choose, and that's to, why don't you take that? And that's to cut your expenses. Both of those increase the inflow of cash, right? So I prefer to make more money. Most people do the cutting of expenses, right? Otherwise, they're waiting around for a raise or whatever it might be. But that's a simple step number one: increase cash flow. Everybody good with that? Okay. Number two, establish an emergency account. So we help people do that through our debt program, but also just by coaching them financially. So a lot of us probably don't look or sound like we're from the financial industry, although we are. But a lot of us are athletes, and so we don't like the financial advisor term or anything like that. I like the term coach. So we coach people to think differently. So establish an emergency account. Think about it differently. Most people think that their savings account is there for their emergencies, right? Would you rather have your savings account be like your dream account, like save for a home, save for a down payment, save for a jet ski? It doesn't matter. That's, in my opinion, what a savings account should be for. And your emergency account, we coach people to have an emergency account that has 6 months of annual income saved up. So I was a teacher for 3 years. I had an annual income of $40,000 a year. Went up a little bit each year. So if you were coaching me, Trey, you'd coach me to have how much in an emergency account? $20,000, right? So I can not only pay for an emergency, but 6 months of relaxation time or recovery time or fix my house time, whatever it is, that's going to help big time, won't it? So seems like an ambitious calling, right? Half of your annual income. However, everybody here can agree that that's something we should all strive for. Okay. So number 1 and 2, pretty basic. Nobody's heard anything earth-shattering yet, right? Like we should obviously want these things, right? So let's go to number 3. Manage and eradicate debt. I won't harp too much on that because we're going to show you a video tonight. You already talked a little bit about it earlier. We have a debt program that's brilliant, and it manages and eradicates people's debt. I was blessed enough to graduate college without any debt, and I never even I didn't take a credit card out until I was 22, and I always just fought it because I'm like, why would I take out credit? And I realized something really like fundamentally kind of messed up about our country, the way we do things, right? I was an elementary school teacher, so we teach kids how to manage their life, and we talk about the American dream. I taught Hispanic immigrants, the sons and daughters of Hispanic immigrants, and so they come for the American dream, right? We teach them about that, and that involves getting an education maybe, but really just working hard and then getting a house, doesn't it? Isn't that the picture? And so when I think about the debt and why I love what we do so much for people is that we teach people about the American dream, and then the big picture of that is a house, and debt's a bad thing, but then you want to go get a house, and to have a house you have to have credit, and to have credit you have to go into debt because you have to have a credit score, don't you? So unless you're really, really cash rich, of course you can have a house, right, Michael? You can get a house if you have a ton of cash. For most people though, you got to go into debt to live the American dream. So we don't like the way that system's kind of set up. It makes sense. It is capitalism, right? It's just the way the free market works. It's not really a crime against humanity. It's just a little flawed in the way we do things. And so we have a system to fight it. Sound good? So we'll show you more about that. Number 4, we're almost done, is EPP, Ensure Proper Protection. I like acronyms because I was an elementary school teacher. So EPP. This is a big one because if you think about what do we insure, what are the things you get insurance on in your life? Almost everything that's really important or expensive, right? Your health, it's expensive. It's actually a law now to insure your health. Otherwise, you pay a penalty. Bigger next year too. Your home, your car. If you're breaking the law, if you're not insuring your car, you insure if you buy a big TV, you probably buy a protection plan on it. Your cell phone. Don't we insure almost everything that's expensive or important to us? Our lives. We insure everything. And the one thing we don't insure that we work the hardest for is our own income. Nobody insures their income. The only way people insure their income is by clocking in or filling out the timesheet or making the sale, right? Or getting the commission. That's how we insure our income. Other than that, we have no insurance for it. Well, that's how most people think. It's not how we think. So again, on the athletes thing, I like to use it as an example, and I'm not done using athletes as an example, by the way. So bear with me. Plenty of athletes do this, but I always bring up Roger Clemens because he had one of the more famous ones. I learned recently that Jennifer Lopez did this on her butt, but Roger Clemens had a specialized insurance policy on his right arm. Roger Clemens was a famous Hall of Fame pitcher for the Yankees, Red Sox, Blue Jays, Astros. He's not in the Hall of Fame. He would be, but he got caught using steroids. His nickname was the Rocket Man because he threw an extremely fast, very fast fastball, like 96 miles an hour on average. And he got a specialized insurance policy on his right arm because that was his income, right? Same reason J-Lo got on her behind. That's her income. Seriously. So I told someone the Roger Clemens story recently, and they told me the J-Lo story back. So I was like, whoa, weird. But
That would be verified, you say.
well, I mean, do you doubt it? So those famous athletes, right, entertainers, they insure their income with different parts of their physical, their physicality that makes them money. Are you insuring your income? Because I don't think anybody here is a famous athlete or entertainer. So are you doing what it takes to insure your income? Well, we have a way to do that too. So we'll show you that. Number 5 is BLT, right? Build long-term savings. So another obvious one and another chance for us to coach people to think differently, because most people, we get paid, we get our paycheck. And where does the money go right away other than the bank? Yeah, you pay everyone else, right? So you pay rent, your landlord, the grocery store clerk at Publix, your Geico representative for your car insurance. Man, you pay everybody else, and then if you have anything left at the end, then you and your family comes last. Isn't the way most people are doing things? Okay? So we just coach people to think differently, okay? Before you pay anybody, pay yourself, because who is the Publix clerk or is your landlord going to come to you when 20 years from now and say, you know what, you came and bought those loaves of bread every week consistently. Thank you very much. We're going to pay you back for all that now and then some. Is that going to happen? No. The only person that's going to pay you later in life is you. And so you should pay you before you pay anything else. It's our simple principle. Pay yourself first. I'm not saying go rogue and live off the grid, to stockpile money, unless you want to. That's kind of a cool idea. That's not what you have to do, though. You just have to think, pay yourself first. Pretty simple. Everybody good with numbers 1 through 5 so far? Everybody not good? All right, let's go to number 6. We'll move on. Preserve your estate's really easy. If you ever have like a death in the family, right? Whether it's you going to heaven or a loved one, something a lot of people are shocked by when they're trying to go through like a mourning process is, where do the assets go and who inherits what? And when you're not ready for that, you don't preserve your estate, people end up facing lawyers, attorneys, judges, you get a bunch of new cousins and uncles when you didn't even know you had when somebody dies, because everybody wants a piece of the pie, right? So we won't harp on that too much either. It's just prepare yourself for those things, so you don't have to face those people and get a bunch of new cousins when somebody in your family dies. Sound good? All right, we're moving on. You got a question?
No, can you give the example of what you thought the estate was when you were?
Oh yeah, my whole life I thought that there's your BLT, by the way. My whole life I always ask if anybody else thought this, but I've noticed recently that I'm more embarrassed because nobody really thinks that. But I always thought that an estate was just a house, a big house, because they're playing. I think they're playing like the Life board game. They say like go into the estates or.
And you're not alone, because a lot of them won't admit it, because that's true what you just said. Most people do think exactly like you.
Yeah, and then you grow up where Trey, you live in the Golden Gate Estates, don't you?
Yeah.
And I used to live in the Golden Gate Estates, and what's in the Golden Gate Estates? A bunch of houses.
Not gold.
I didn't realize that an estate is actually a combination of what you own and owe. So it's not necessarily a good thing. An estate can be a bad thing to inherit. So, watch out who you're going to kill in your family. All right, so let's move on, and we'll bring up another speaker to continue to explain this. We're going to move forward into a point where we'll show you exactly how we're accomplishing all these things. So stay plugged in. So we brand ourselves as a consumer advocacy group because, listen, we didn't always think or know that finances is a huge way to help families. We started out, in fact, in the utility industry. Here in Florida, you all know who we have to pay for our energy no matter what, right? FP&L. It's a monopoly on the market. Well, other states, in fact, 16 states in America are deregulated. And when I say that we're a consumer advocacy group, try saying that 5 times fast, we just want to help people in terms of saving them and making them money. And so we started out in utilities in states like Texas, New Jersey, DC, Massachusetts, because those states are deregulated in the energy market, which means you can choose and compete. Those companies can compete for your business. So we help people save money on energy. We just realized as time went on, especially being here in Florida for us, we're not deregulated. Why focus on that here? When we can focus this, which is people's retirements and qualified funds and fighting against big institutions that leave people with a lot less money than they thought they'd have later in life. We mainly fight against taxes, market loss, and paying big fees and commissions to the broker Joe and broker Sue. We'll explain all that. So we consider it to be a crusade because, you know, we could all be doing different things. I don't think anybody in this room on our team is in love with the we love the money that we often make to do it. However, I certainly wouldn't be doing it if I didn't feel like I was making a huge difference for people. So that's why we consider it a crusade and we have fun. So let's go to the next slide, and then I'm almost done. So one more time with athletes. Anybody know who Bear Bryant is? Bear Bryant. Okay, Bear Bryant, if you don't know, is probably definitely the most famous college football coach of all time. For NCAA, coach for Texas A&M, Alabama, and he's what put those schools on the names and the kind of pedestals they are. They're really well known for football. Well, he started that, and they have a big statue out front of him, and his what's kind of hat he wore? What's that called? Fedora. Yeah, he's famous for wearing a fedora while he's coaching. He kind of made that famous. And he coined the phrase that offense sells tickets and defense wins national championships. So he coached his teams with defense first. And we're relating it to finances because if you're making money and you're working hard for it, wouldn't you want to play defense against it? Because you know people are trying to get it, right? Someone actually gets it before you do. If you get paid, you know, the government takes your income tax, don't they? So let's play defense with our money against all the different hands reaching after it that we can. So defensively, we want to play defense against three things. The first one is market loss. So everybody remembers 2008, right? Nobody here is too young. 2008, big crash. And then if you pay attention to the market in the past 2-3 months, it goes on a roller coaster again. But generally in the past 6 years, we've been in a bull market, which means we've been going up consistently. And we reach record highs. And then in the past 3 months or 2 months, we've reached single day record lows. So it's like a roller coaster. So I always say I'm going to go up to Tampa Busch Gardens and have them name a roller coaster just the stock market, because we don't want to be riding that roller coaster when it's what we're doing for our families long term. And I have stock investments, so I'll be the first one to tell you that. I only have that though because I do have a secure retirement nest egg that is not subject to market loss. So we want to play defense against that, right? Let's go to the next one. Defensively, we hate fees and commissions, okay? Because me personally, I had a 401k as a teacher. Tennessee Consolidated Retirement System took $80 or $160 every pay period, or $80 every pay period, $160 every month out of my paycheck. I didn't even know about it my first year. It took me a while to realize where my money was going. Long story short, I sort of retired as a teacher. I resigned, right? And I had about $7,000 built up in a 401k account. Didn't know if it was doing well or not. Didn't know who was managing it. But I was definitely being charged a ton of fees. And then just to take it out before I am 59 and a half, they want 20% off the top. Unless you do a bunch of paperwork and move it to another qualified fund where you get taxed and penalized. And it's a nightmare. You can talk to me about it later. But we hate fees and commissions. We don't want to have to pay people money to manage it. Whether we win or lose, they get paid. That's how most qualified funds work. We fight against that, okay? Let's go to the next one. Taxes, we'll talk more about that. But the big question that I want y'all to think about is if you could opt out of the tax system for your retirement, you know, how soon would you want to know about it? Because we pay taxes on almost everything, right? Why would you want to be part of the tax system for your retirement if you can completely, legally, and morally opt out of it? Well, you can. So we'll talk about that tonight. Let's go to offense. So we played defense against all those deadly forces against our money, didn't we? Let's go play offense so we can advance ourselves. Go ahead. So growth, that's obvious, right? We want our money to grow because we're working so hard for it. Don't let it be dead money, not working for you. Your money should be working for you because you're working for it. So let's have growth. And to have growth, another obvious one, we need income. So the best time to grow your money is when you're making it, right? Not when you need it the most. So let's have income so we can grow our money. Safety. Safety sounds like a defensive term, doesn't it? Why is it on offense? Because we'll show you a mathematical formula tonight called the Rule of 72 that shows you just how dangerous losing money as far as percentages go. When you really understand the power of compounding interest, you know why safety is an offensive term, because every time you lose the power to gain. Okay? If you had told me that a couple of years ago, you know, before I ever got into this, I would have said, what? Lose the power to gain. So I know it sounds confusing, but we'll show you what that means in the Rule of 72 in just a minute. And liquidity is my favorite one. Liquidity is so important. You have access to your money. Everyone wants to put away, right? everyone wants to save, but can you grow it and have it away from taxes, not pay fees and commissions, keep it safe from the market, and have liquidity? Not many people can say that, okay, because they're not paying attention. So pay attention, you'll find out how we do it. And lastly, we already mentioned this, tax efficiency. So we'll talk about how we protect our money from taxes and retirement and grow it in that same way. So next, I'm going to bring up a former scientist to explain to you the Rule 72 and kind of rack your brain a little bit about how we get where we're going. And that's Ryan.
I'll stand up. Oh, yeah. I'll stand up for this because I'm able to. So this is the rules of the money game, basically. Has anybody that's new here seen the Rule 72 before? No? Seen it, Mike? Awesome. Okay. So try to operate that correctly.
Okay.
The Rule 72 is basically, if you don't know the rules of the game, you can't play it. That's just how it goes, right? If you go to a lake house in a cabin and the first thing you take out is what? The instruction book, right? Because you got to read it in order to know how to play the game. Most people don't know the rules of the game. The most important thing in our life that controls everything we do is money, and most people don't know the first thing about it or how it works. So Rule 72 is the first step in understanding that and what compounding interest is. This guy right here, anybody recognize him? Yes? Okay, that's Albert Einstein, obviously. Pretty smart dude. Would you agree? Yeah? Okay. Yeah, he's the grandfather of physics, and I'm a former scientist, biologist. So props to Einstein for killing that game. He said that Rule 72 is the greatest mathematical discovery of all time, and he came up with the theory of relativity also, which governs physics. So you can imagine how important this is when he's saying it like that. So what that is it's how money doubles with compounding interest. So we want to try to understand that. And the way that we do this equation, you take whatever interest rate you're earning on your money, you divide that into 72, and then the result of that math problem is how many years it's going to take for your money to double on itself one time. So for example, 72, if you were earning 1% interest rate, 72 divided by 1 is what? 72. So it would take 72 years for your money to double once. How many people want a 1% interest rate? Not many, right? It's not very good. So what I'm going to do here is I'm going to make you all a deal. I'm going to turn you all 23 years old right now. Get all those years back on your life. Is anybody 23? No? Okay, cool. So I'll give you that deal first. Secondly, you're going to come to my bank, Bank of Ryan, you're going to deposit $5,000 in an account with me. It's your money. I just hold it like any bank, right? So I'm going to give you 2% on your money also. Does anybody know how much banks are paying right now on interest on a passbook savings?
0.2? Yeah, probably less than
0.02. So yeah, 0.02%. So you can watch your bank account for 10 years and probably get a couple of cents on your balance. So I'm going to give you 100 times what the banks are actually paying. I'll give you years back on your life. I'm going to give you a brand new Vespa and a helmet with Mohawk on it that you can ride around all day if you want for free, just to open an account with me.
Tony would love that in his neighborhood.
So you're coming to my bank, Tony? All right, good. So,
Get the neighbors.
yeah. Here we go. Rule 72 says if I'm giving you 2%, 72 divided by 2 is 36. So your money's going to double every 36 years. If you're 23 years old and you have $5,000, you will be 59 years old and have $10,000, and then at 95 you'll have $20,000. So what are you going to do? What's your name again?
Mitch.
Mitch, that's right. What are you going to do with $20,000 at 95 years old? Property?
Yeah.
So think about this.
At 95.
Well, think about it. A new car, what does it cost nowadays? Probably like 30, 35,000. What did it cost 70 years ago?
1,500.
Probably 1,000 to 1,500. So 70 years from now, what is a brand new car going to cost? And what is $20,000 going to be worth? Probably not very much, right?
1 square foot of property.
Well, yeah, you're gonna be able to get some a square of turf that you can sit on if you'd like. That's about it. So not great, but you're still getting the Vespa, so enjoy that. Go ahead. Woohoo, there's some sarcasm built into this. 72, now I'm gonna make the deal a little bit sweeter. I'm gonna give you 6% on your money instead. So that means 72 divided by 6 means your money's gonna double every 12 years. So same 23-year-old, same $5,000. All I did was increase, stop using that calculator, I see that. All you gotta do is I tripled the interest rate and I cut the doubling time down from 36 to 12, which is 1/3 of what it was. So I'll take some wagers here. I'm gonna make you a deal. Take a guess. What are you gonna have at 95?
Oh, wow. I don't.
Just take a shot. If I tripled the interest rate and cut the doubling time into 1/3.
40,000, I'll say.
40,000? Okay. Give me a guess. 60? All right. Mike, you got a guess if you didn't already calculate it? You got a guess? What are you going to have at 95 years old? If I tripled the interest rate and cut the doubling time into 1/3, same 23-year-old, same $5,000. Stop doing the math, just guess.
Oh, it's much higher than that, right? It's 2 to the 7th. It's,
All right, stop. Too long, you're out. I'm gonna make a deal. I'm gonna give you the money you guess, and I'm gonna keep all the change. That's my bank, and I say so. So let's go. All the way out to 95, and we're sitting at $320,000. So you guys just paid well over $200,000 for a Vespa and a helmet with Mohawk on it. Not a great deal, right? I mean, you can probably get a lot better things for that kind of money. But thank you for your business. I appreciate it very much. So I'm gonna make it a little sweeter again. I'm gonna give you 8% now instead of 6. So all I'm doing is I'm increasing it by 2 percentage points this time. I'm not tripling it. And then I'm cutting the doubling time down by only 3 years. So if you're the same 23-year-old, same $5,000, tell me what you're gonna have at 95. Just take a shot.
say 900.
900,000. Okay. There you go.
I'll say 750.
750. Okay. You got to guess this time, Mike, or are you calculating? 3, 2, 1.
No, I don't have a guess.
Okay. All right. Forfeit. Okay. So I'm keeping all of Mike's money, and I'm going to make you guys a deal. I'm going to give you what you guessed, and I'm going to keep all the change. So here we go. Running it all the way out. We're sitting at 95 years old, $1.28 million. So even though you guessed way higher, and it might seem like your guess was a little closer than last time, you paid more for the Vespa this time than you did last time. And I appreciate your business. Thank you very much. So the banks are paying what? 0.02% on a savings account? This is 100 times higher than that. So people, when they get their paycheck, where do they go first? The bank, right? They put their money in the bank and it sits there. So, and also, there's a lot of people that I came across that aren't even thinking about saving for retirement in the future, and they have all their money in the bank or under their mattress because they're scared and they don't know what to do or where to go. So that being said, they put their money in the bank and they're getting not even this much right here. What do you think the banks are doing with the money that they have in the bank? They're over here. That's A, this is B. If you had your choice, what would you rather? Oh, it's B, right? Clearly. So, is that okay?
I blanked out on it. Somebody was emailing or doing something.
Oh man.
Somebody was responding on the thing saying, my guy doesn't even make that much.
Oh really?
No, yeah, I don't know what it was, a message in the bottom.
Okay. Anyway, so the banks are doing this right here. So is it even morally okay or acceptable whatsoever for the banks to go and give your family less than $20,000 and keep $1.26 million that could belong to them and their families for their survival and their future? Not at all. That's not morally acceptable. And why do people even do this? Because they don't know where else to go or what else to do. They don't have the education. They don't know what their options are. And they're dealing with all the things we've talked about that we got to defend against too. So how are they even doing this right here? We call this legalized extortion. I mean, if you go to a big city and you look up at any buildings, what do the buildings say on them?
Chase.
Banks.
Banks, mortgage companies, insurance companies. They're huge, huge skyscrapers with tons and tons of employees. Who's building those buildings? Each and every one of us, maybe individually, at examples like this. You know, we're building skyscrapers for other people because we don't know where else to go. So we call that legalized extortion. They're doing this. They're earning not just 8%. They're earning more than that. Does anybody have a credit card in here? Okay, a bunch of credit cards. The highest interest rate on a credit card is about 33%. So think about that in terms of the Rule 72. Because the Rule 72 doesn't just work for you, it works against you too. Compounding interest can work against you in a horrible way. So 72 divided by 33 is what? Just 2.2 about, something like that. So the banks are doubling their money on some people's credit cards every 2.2 years. And then if you're late by a day, they're going to charge you 35 extra bucks. And then they're going to jack your interest rate up as high as they can make it. So they're making tons and tons and tons of money, not just on credit cards, because they're taking all the money people are putting in the bank, lending them to other people via credit cards. Then they're lending them money for mortgages and things like that. So they're taking Bill and Bob and Sue and Jane's money and saying, oh, here you go, Pete, you can have it. Go buy a house. We're going to charge you, you know, for the low cost of $200,000, we're going to lend you $220,000. And you'll see why that happens right here. And the first thing we got to figure out about the whole Rule 72 is how to make it stop working for everybody else and start making it work for ourselves. So debt is a drag. We got to figure out how to defeat it. And that's what we're going to do right now. So I'll show you this really quickly if I can maneuver around here. Oh, there it is. All the speakers are in my bag here. Maybe we can hear it without them, but I prefer to have them. Set it up real quick for you.
There's a quick short video, it just gives you an overview. What this talks about is debt. It focuses right now just on mortgages only, but it applies to any and all debt. We have many clients throughout the country that have only maybe car loans or student loans. As a matter of fact, in this newspaper, it was just in Sunday's newspapers, is talking about what a scam student loans are. $1 trillion student loans. We've helped people, Ryan's got clients that are just student loans. 140,000 student loans or something like that.
Yeah.
I mean, ridiculous, okay? Kid's never gonna pay it off, ever. And I was telling Tony the story, I started telling the story. We did a class for that professor, and the professor teaches a criminology class, remember that, Trey? He afterwards wanted our help and said that he's overloaded with hundreds of thousands of dollars of debt, and what he's waiting for Obama to do, this is right out of his mouth.
Yeah.
He's going to default on it, so they just write it off.
Right.
He's a professor at a university teaching an ethics class. He's going to walk away from his loan and let all of you absorb that debt. That's exactly what's going on. He said it.
We know it. It's gotta happen.
So we're going to go back and do a
Thank you,
class
Dave.
on him. Okay, and think about that, folks.
All right, we're set.
Okay, good.
Did you know that millions of Americans are overpaying their mortgages? And not by a little, by tens of thousands, even hundreds of thousands of dollars. That's right, and it's all in interest payments. The fact is, most Americans could be living the lives they've always dreamed of if they weren't spending the majority of their adult lives paying for the lives their lenders have dreamed of. In this video, we're going to show you how overpaying your mortgage is robbing you of the future you could have, and what you can do to stop paying for somebody else's dream and start turning your financial dreams into reality. So let's get started. Meet Bob and Katie Smith. The Smiths own their own home, and they're in a pretty typical mortgage situation for millions of homeowners across the U.S. Your individual mortgage details may differ from this example, but the financial principles remain the same. Bob and Katie have a 30-year mortgage for $200,000 at a 4.5% interest rate and a monthly payment of just over $1,000 per month. Bob feels like they're pretty lucky to get a 4.5% rate. I mean, that's a great deal, isn't it? Well, to answer that, let's take a closer look at that 4.5% interest rate. How much of the Smiths' payment every month is going toward interest, and how much is going toward principal. By the end of the first year, they've paid their lender more than $12,000. Of that, nearly $9,000 went toward interest. That means that over 73% of the money Bob and Katie paid their lender in year one went toward nothing but interest. That's 73% of their payments up in smoke. And in year two, it doesn't look much better. Once again, Bob and Katie paid their lender over $12,000. And of that, more than $8,700 went toward paying interest. That means that in year two, over 72% of the Smiths' money went toward nothing but interest. Now let's fast forward to year 20. By year 20, Bob and Katie have paid over $243,000, but they still owe their lender over $97,000 in principal on their loan. That means that after paying all that money, the Smiths still owe almost half the original amount they borrowed. And by year 30, the amount Bob and Katie have paid their lender totals almost $365,000, of which nearly $165,000 went toward paying nothing but interest. That means that they've paid their lender over 82% of the amount they originally borrowed just in interest payments. That's 82%. Quite a far cry from the warm and fuzzy feeling the Smiths had when they heard they got a 4.5% loan. So where do all the billions and billions of dollars homeowners are paying the banks in interest go? Exactly. Homeowners like Bob and Katie from all across the nation spend their lives making interest payments to the banks and wonder why they never get ahead. But guess what? It doesn't have to be this way anymore. What would you say if someone told you that there is a simple online banking solution helping homeowners like you put an average of 18 years or more worth of mortgage payments back in their own pocket? How excited do you think people like Bob and Katie would be if instead of having to pay the bank over $164,000 in interest payments, they could pay less than $63,000, the same amount of interest they would pay if they had just a 1.9% fixed rate on their mortgage? That's nearly $102,000 in interest payments they would save, and their house would be paid off free and clear in just 12 years versus 30. Thanks to our online banking solution, Bob and Katie would be done making mortgage payments in just 12 years. What could you do with over 18 years of mortgage payments you no longer had to pay to the bank? Just imagine the possibilities. And you don't have to refinance. You don't have to change banks. You don't have to increase your minimum monthly payment. And you don't have to modify your mortgage or change your mortgage terms in any way. Just imagine the freedom you would have if you no longer had to make mortgage payments to anyone. Don't waste another minute. Watch the corresponding overview video right now.
We don't have to do that. So basically what this is that it's the first step in the process of making the Rule 72 work for you instead of everybody else. You saw the ugly bald guy. He is the guy who's collecting on your money. And just so you know what this is, we talked about it a little bit. It's basically like a GPS system. Like how many people use one to get here tonight? Yeah, you did. So you plug in the address. It tells you exactly what you got to do step by step to get to where you want to be. That's all it does. Step by step. All you do is follow directions. And if you take a wrong turn and go the wrong way, what does it do? Reroutes you. You get right back on track to get right to where you need to go. So that's what this does, and that's what this is. It's a long story to explain the complexities of how it actually works. But being a guy who does statistics or did statistics for a living, I can tell you that it does because I've looked into it a lot. So that being said, we use this to help people pay off mortgages. And one example for my own clients in life is I had a good friend of mine who had about $70,000 in student loan debt, had $180,000 left on a mortgage, had 12 different credit cards with a couple hundred here and there, nothing major. He was slotted to be in debt for the next 28 and a half years, doing exactly what he was doing. and he didn't think he could make any extra payments, or he was trying to a little bit, and that I accounted for. And just by following simple instructions, he could get out of debt in 7.2 years, saving himself $154,000 in interest payments by not changing his budget whatsoever, just by following instructions. So very, very simple and very much a no-brainer. And what he didn't even realize is that when he signed up to get that debt, they didn't send him a flyer in the mail that said, we have the deal of a lifetime, come to the bank today, sign up to get this loan, we will lend you $200,000, no, I think it was like $230,000 for the low cost of $210,000. So I'll let you borrow this $220,000, but you're gonna have to pay me back an extra $210,000 on top of that. But take your time, go for 30 years, no big deal. Just get it to me when you can. That's the flyer that they should send you in the mail, because that's what you're signing up for and agreeing to. Anybody who has debt or mortgages or loans or anything already agreed to those terms. You owe that money no matter what. If you have a student loan, you got to pay the balance of your student loan. They're going to get you no matter what. They're going to go after your kids if you leave the planet. In a real estate mortgage situation, this, Mike, the value of your home drops, you still owe the value that you borrowed. That's it. You're stuck with that. And you're stuck with the interest that you're paying on that original balance. So a dangerous place to be. So debt's a drag. We want to eliminate it. And then where do you go and what do you do after you get out of debt, or while you're trying to generate earnings so you can have a comfortable retirement? That's what we're going to show you next really quickly. This is even shorter. So it's good. If the internet's working, I think it is.
Thanks for joining me here. I wanted to give you a quick snapshot on what it is that we're doing. This is a snapshot of our program, Red Line, Blue Line. Not knowing anything about anything, if you had to choose one of these two lines to put your money on, would you choose the red line or the blue line? The blue line, of course, right? Because it's more money. If you look close, what you realize too is that it never goes down. It only goes up. Never go backwards. Gains are locked in. But the story gets better than that. In addition, that $211,000 is income tax free. The red line is the Standard & Poor's 500 index. That's the stock market. 500 of the largest stocks in America. And if you look at this 165, about 95% funds do not outperform the Standard & Poor's 500 index, meaning that most people in mutual funds, 401ks, IRAs, so on, actually had less money than the 165. We still have to deduct fees because fees didn't come out of this. The average fee is about 3%, can be anywhere between 1.5% to as much as 5%. Many people aren't even aware that they're paying these fees because they're hidden in what looks like a phone book written by a Philadelphia lawyer called a prospectus. But when they examine that, the Los Angeles Times said the average is about 3%. And in this case, on $100,000, that would be about $3,000 a year in expense that you have to pay, by the way, whether you make money or lose money. And if we just roughed the numbers out and said $3,000 on $100,000 over 15 years, means you'd have to subtract $45,000 out of this number. But we still have to take taxes out. And if you even looked at a 10% or 15%, 20% tax bracket, very conservatively, you're about where you started 15 years earlier. Now, you put up 100% of the money, took 100% of the risk, and ended up about where you started 15 years later. I want you to think about this. The mutual fund company put up zero money, took zero risk, and they made $45,000 in the process. $17 trillion today is on the red line in qualified plans. That's 17 trillion with a T. Without anyone spending one additional dollar, don't you think that most people would prefer to be on the blue line? In addition, This comes with all sorts of other benefits. This is net of fees, charges, expenses, and it's also income tax free. So here we have a smarter, more complete alternative to 403b, 401k, IRA, mutual funds, to the stock market, where you don't have the risk. By the way, that $211,000 is guaranteed never to be less than that. It can only go up, never go down. In addition, there's other benefits that come along with it. When you look at the whole package, it's, again, a no-brainer to.
Back to this. Oh, are you there? I'll keep going. All right. So we're talking about red line, blue line. If you had your choice, which one would you take? Blue line, obviously, right? It's another one of those semi-rhetorical questions because it only makes sense that you do the blue line. This is what we talk about a lot. One size doesn't fit all, obviously. We always cater to everybody's individual scenario when we're looking at options and what the best moves are for advancing your scenario. But blue line, what even is that? Can I get a click? Okay, so we call it tools for modern day personal finance because a lot of the tools that people are using right now for their own financial lives are antiquated and outdated and unsuccessful, really, when you look at the history and you know the story behind what the normal things that exist right now in society for people to use as a vehicle for growth. You'll know that they're very outdated. This is the blue line. Blue line is called Index Universal Life. It gives you three things. And this is what it gives you. It gives you life insurance, it gives you living benefits, which everybody needs, very important. And nobody likes to talk about life insurance. People need it for various reasons. Young people don't always require it, but we use it for a lot of different reasons, and I'll tell you why. And also tax-free retirement. So really what it's doing is it's taking care of you if you live too long, die too soon, or get sick along the way. It's covering any one of those scenarios. So what else does this do? It defends against market loss, number one. You saw the blue line only went up and it never went down, right? So you can never lose money in the market, contractually guaranteed. That makes sense to me, and I like that. High commissions and fees, we defend against that, with the expense ratio being about half as much as standard accounts that people are using for their retirements. Tax loss, you are able to put your money away, grow it tax deferred, and pull it tax free, which doesn't exist in any other vehicle that I know of. Declining health, critical, chronic, and terminal illness. If you get caught in any one of those scenarios, and we'll talk about that more later, you're protected there too. And estate tax, you can pass your money on free of estate or probate tax. Don't have to worry about Uncle Sam picking everybody's pockets after you're 6 feet under. So how is this even possible, and how did this even come to exist? Because most people, finance guys, you know, people with masters and MBAs, they don't know what this is or understand how it works at all. Even people in the insurance industry and the investment industry don't know what this is or understand how and why it works. So how did it even come about, first and foremost? Give me another click. 1950s, or 50 to 70 years ago, the tax code was written. Has anybody read the tax code in here? Slow it go. No, nobody's read the tax code? Yeah, nobody's read the tax code. That was a trick question. It's 93,000 pages long. Not even your CPAs have read the tax code. Accountants, nobody. They don't know what's going on. I just had somebody complain to me today about how their accountant messed up their whole tax scenario because they didn't know everything, and that's just the case and how it works. So the tax code was written, and it just so happens that we know several tax codes that allow us to use what this is to allow us to put money away tax deferred and pull it all tax free. It's tax code 7702 and 101. You can look it up. That's what it says. It says as long as your money is wrapped around a life insurance product to a certain ratio, then you can grow it tax deferred and pull it tax free. So very powerful in the end game. In 1976, indexing was developed by John Bogle. Has anybody heard of John Bogle? I know you guys have. Okay, John Bogle, one of the most successful investment guys of all time, very, very wealthy guy. And he invented indexing. And what that means is that he had a bunch of investors around him that were buying, selling, trying to beat the market all the time. And the truth is, like you heard in the video, 97% of mutual funds and investors don't beat the average of the market, 97%. So John Bogle said, you're crazy. I'm going to invest the same dollar amount across the board. And what we use now is the S&P 500 as our main index to gauge what the economy is doing. And he sat on it. He didn't buy and sell and trade or anything. He beat 9 out of 10 of those investor guys. Same statistics. And I looked up, so I do literature reviews sometimes to verify stuff because I'm a science guy. And I found some white papers that actually did the numerical study and the data. And it said that indexing beats any other form of investment strategy 92% of the time. Like, what else makes any sense? Would you do anything else? I don't think so. You know, if you were in a casino and there were slot machines and one said, this wins 92% of the time, and none of the other ones said anything, which one are you going to sit at?
92%.
Thank you, Trey. You're going to have to wait in line, though.
You did really
A
good.
very long line. It's going to be out the door around the corner because everyone's going to want to sit at that slot machine. So give me a click. So indexing in 1976, that's the I in IUL. So we're using that method here. So in 1999, the laws changed drastically. And there used to be a law in the books called the Glass-Steagall Act. The Glass-Steagall Act said that investors could only do securities. You know, security guys, brokers, could only do stocks, bonds, mutual funds. Banks could only do banking products. And insurance companies could only do insurance. Don't cross the streams. Stay in your industries. Then the government always thinks they know what's good for people, so that's what they said back then. In 99, they came in and said, whoa, wait a minute, competition is good for the consumer. So this is all, you know, they come from the same branch. So let's erase Glass-Steagall, and now they can go compete. So out of banks, brokers, and insurance companies, who do you think came on top in that competition? Does anybody have a guess? What do you think, Mike?
I already guessed.
You already guessed?
I still want to guess wrong.
Okay. What was your guess?
I said banks.
Okay.
Insurance.
Insurance, you said? Okay, you know, why is that? You have a good, what do you think?
It's just because that's what you.
Yeah, I get that.
Very good deduction, Tony. You get a lollipop at the end of the meeting.
That is very good. Well, this is why, because they have more money than anybody else. Think about it. Well, does anybody drive in here? You have to have car insurance, don't you?
Yeah.
Does anybody own a home in here? You have to have homeowners insurance. Does anybody have a living, breathing body that they operate on a daily basis? You have to now have health insurance. So everything is insured. Cell phone insurance.
Banks are insured.
Banks are insured. The money in the bank is insured. The people in the bank are insured. The building that houses the money in the bank is insured. Everything. And what is insurance? It's risk management. What that means is that you're betting against, the company's betting that you won't die, and you're betting that you might die. So there's even products called term insurance policies that last for a certain amount of time. If you don't die within that time frame, or if you don't drop your cell phone in the water when you have cell phone insurance, what is all those premiums you've been paying to the insurance company? It's 100% profit, every bit of it. So think about that. And the truth of the matter, and the statistics say that insurance companies control 85% of the entire global wealth. I'm talking global, like planet Earth. That's the entire world, 85%. So of course they came out on top when competition came out. They have more power than anyone else in this whole entire branch and industry. So go on one more. And this act allowed the different types of companies to develop different types of products. Now you can go get life insurance from a bank. And now you can go get banking type products from investment guys. And now insurance companies can dive into those two worlds also. So that brought on the development of the IUL, and like any new product or technology, has kinks in it at first. So those were eventually worked out by 2004, and it's still improving to this day. And it just was updated a little bit in 2015, actually, which made it even more powerful. Okay, go on ahead. So, okay, so go back one more. Yeah, so it gives you these three things. We use life insurance not only for the ability to pass your money on tax-free, but because you can put it away and grow it and pull it tax-free, where you can't do that anywhere else. Secondly, living benefits is one of the most important things that we do and why we do this. Everybody needs it. I don't care what you say. I've seen things happen to people that are very unfortunate and they weren't prepared, and it devastated their entire lives. People that were well off and doing just fine. So if you say you don't need living benefits, then you're absolutely nuts. And I'm going to bring up Trey Carter to talk a little bit more about that.
Trey Carter.
All right, good evening.
Good evening.
All right, let's try it again. Good evening.
Good evening.
All right, there we go. So, I don't know what that is.
Sorry.
My name's Trey Carter. Been with the company for about 1.5 years now, and I'm going to tell you what living benefits is and why I'm a part of this business, why I'm passionate about it, and why, to me, this isn't even work. This is helping people and making a profound difference in somebody's life, because this really is life-changing stuff that we're talking about. And we're talking about growing money, saving money, getting debt-free so that we can live, a healthy lifestyle in our later years. However, what happens if we don't make it there? And what I mean by that is who in here knows somebody younger than the age of 65 that's had a heart attack, cancer, or stroke and survived? Everybody? And it's so common, especially once I joined this business. It's so common. I see it everywhere. And it's a fact. You see it up there that 7 out of 10 people are going to have one of those big three before they even turn 65 years old. So what I mean by that is there's approximately 10 of us in here. 7 of us are going to have a heart attack, cancer, or stroke. Who's it going to be?
Not me.
He's got an inside track here.
and Tony, and that's what we all did. I'm young, 25 years old. I work out, I run, I feel like Superman, and reality is, I know there's a good chance, a 70% chance to be exact, that I'm gonna get sick. It runs in my family. So, what living benefits is in the case that say Mitch, you have a $100,000 life insurance policy. Do you own life insurance, Mitch, Tony?
Yeah.
You do? Okay, great. Now, do you have the old kind or the new kind?
Hold
Okay, so you probably didn't get my question. I'm going to explain to you why you have the old kind. What do you have to do to benefit from your life insurance?
Me die.
Got it. Amen. So you got the old kind.
Well, I don't benefit.
Yeah, amen. Amen. And even in the good book, it says every wise man establishes a legacy for his children's children. That's why I have life insurance, because I want it for my family. I want to leave a legacy. However, living benefits is another reason that I have it too, because I don't know how much your life insurance is. Let's say it's $100,000. You have to die to benefit from that. Now, what if you didn't have to die to benefit from it? And you could actually benefit from it while you're alive. And what I mean by that is, in the case you become critically, chronically, terminally ill, heart attack, cancer, stroke, ALS, all that crazy. You lose an arm, you go blind, major burns. You do not need to die to access that money. So in the case you become critically, chronically, or terminally ill, they will actually advance your death benefit when you need the money the most. You follow me?
Mm-hmm.
So that's huge. If you were to have a heart attack tomorrow, would you have a good standard of living for the next 6 months while you recover?
Yeah.
Yeah, if you have living benefits. However, the problem is a lot of people don't. They have a heart attack. Can anyone tell me the average age of a heart attack in America? 42 years old. What's the average age of a bankruptcy? 43. And I just, why do you think? I just gave you the answer. Someone has a heart attack or, any serious illness, they're not going to go right back to work. And then what happens when we start draining our retirement accounts, and then we go bankrupt? And you can see it right up there, over half, 2/3 of bankruptcies are due to medical expenses. So the reason, and just how this came about actually is the Bernard brothers. This is a true story. They started like major organ transplants, and they did a lung transplant on this lady in her mid-30s. And like I said, this is a true story. And she received the lung well. She, the doctor said, don't go back to work, be in remission, rest, recover, recuperate, etc. She came back for a checkup some months later, and she just looked like death. And the doctor said, what are you doing? What's going on? She said, Doc, you don't understand. I have 2 kids. I'm a single mother. I got to put food on the table. I have to work. I don't have a choice. And long story short, she ended up dying some months later. And she had life insurance that got paid out to the kids. And I ask this every week, do you think those kids would rather have their mother or the life insurance money? Mother, right? So that didn't sit right with the Bernard brothers. And what they actually did is they flew over to Europe, where they have a big influence with the insurance companies. And they said, look, we're over here saving people, and you're over here killing them. What life insurance companies are, majority of them are what you call legal reserve company, meaning if you have the $100,000 life insurance policy from day one, Tony, they have to have 103% of that money in the account at all times from day one. So they already have the money sitting there. And they said, you know, the Bernard brothers said, why don't you give them the money when they can use it the most? So now you no longer need to die to benefit from your life insurance. And that's where Living Benefits came about. And out of about 2,700 different life insurance companies, there's only 18 to 24 that offer living benefits at no cost. It doesn't cost anything extra. And on top of that, there's 149 million people like yourself, Tony, that have life insurance that they have to die to benefit from. So would you rather have the old kind or living benefits?
Gotta ask my wife that question.
Yeah. Well, me personally, when I seen this, I didn't want to be a burden on my family. We're young right now. Anything can happen. And I have a family that I got to provide for. And if they got to sit there and take care of me, I'm doing nothing except be a burden on them. And the reason is because I actually lost my mother at the age of 18 because she had 2 strokes. And she didn't pass right away. I grew up, you know, very lucky, beautiful home, etc. And then, you know, once she had a couple strokes, she was bedridden for all of high school. And slowly just seeing what it did, not to our family as a family, but financially. And she ended up passing. And when she passed, we ended up going bankrupt, lost the house. My dad lost the business. And I actually became homeless. And that's my life. So when I seen this is something that hit home with me. And this is why I'm passionate about it, because I know that people need this. I just have a hard time portraying the message because people are so cynical nowadays. They don't realize what's really good for them. If a hurricane's coming, you prepare for it. However, you're not going to prepare for your own life and do what abides with common sense. And what you get here is, you know, a lot of people, Tony, like yourself, have life insurance, then they might have chronic or critical insurance, and then they have a retirement plan. What this is it's life insurance. It's all 3 of those in one premium. So instead of paying, you know, $200 here, $200 there, $200 here, you can put it all with one premium. You're covered in case you die too soon, live too long, you get a tax-free retirement, and then if you get sick along the way, you're paid out. So it's a win-win-win situation. And does anybody in here like paying taxes? Didn't think so. So if you don't have to pay taxes, tell me why you didn't. That's my favorite question to ask people. When you could opt out of paying taxes, tell me why you are. And you know, I don't know any better. So living benefits, that's my spiel. That's why I'm here. I feel like I'm forgetting something. I don't think I am though. However, thank you guys very much for your time. And I'm going to go ahead and bring up Coach to close this out.
Thanks, Dave. Good. So, you know what we try to do? Ryan, can you, give me that, please. And can you switch those consumer reports over to me a little bit? So, you know what we try to represent, Tony and Michael and Mitch, is that this all comes down to common sense. You know what most people lack when it comes to money? Common sense. All the time. Because you weren't taught that in grammar school. I know it because I wasn't taught it. We come from the same school systems. We saw that Rule 72 that did it for me. That simple principle because we got so mad at it. So common sense is important. Here's the other thing. All of you know somebody that works in a corporation, or maybe you've had, and because you're self-employed, you may not have, maybe give it to your employees, but you start a 401k plan or a 403b plan or an IRA. It's the biggest scam perpetrated in the American public, bar none, and nobody knows it. You all get it because that's what you were taught to do. Why do people do it? When you walk in the HR department, they say, "Hey, Tony, now fill out this form." Okay, listen, and by the way, that's for your taxes, so why don't you put a 0, maybe 1, okay, for that alone. And then, by the way, you can opt out. They have a 401k. Wonderful. It's for you, and we'll match you. So, you know, go ahead, you can opt out. You don't have to get it if you don't want to. But so everybody, without being told what it is, they don't ask any questions. They have no idea what they're paying, why they're paying. They have no idea where the money is. They just think the company is going to take care of them. How many of you are going to stay naive and think that way? because it's not happening. In fact, there's major lawsuits right now in this country being done with all of you that have 401ks. Fidelity, one of the biggest investment companies in the world, just lost a class action suit to their own employees because they were overbilled. Unbelievable. But everybody said, oh, I got a 401k. Shame on you. But nobody knows that. Okay? And I watch. Now, we asked us the questions. Do you have one, Mitch? You do?
I do.
For your own company?
Yep.
Great. We're going to fix it for you if you want it. Now, watch. So I'm going to role play for a minute because you mind role playing with me?
Absolutely.
Okay, it's exactly what we do. Okay? So if you have a 401k, who's your partner in your 401k with you?
My cousin.
Wrong answer, but good thought. Okay, he's your partner in business.
Yeah.
But but your 401k, you know who you're.
Myself.
Now let me ask you another. Let me divert it for a minute. How long have you been putting into that?
2 years.
Okay, good. And how long are you going to continue contributing to it?
A long time.
So how much of that money that you're going to save in there can you afford to lose? Just remember you said that. Boom. Do you mind if we boom people, Tony? No, as long as it's not you, right? Okay, no. Okay, because we boom people and we have fun at it. See, but it's stuff that you don't think about. So here's the deal. So you're going to put all that money away, and in just a minute, it's a lot of money long term, and you're saving it for you. And we just said, how much for you? You said none of it. Well, let me go back to your question. I'm going to rephrase my question. When you go to take your money out, and you're all going to want to take your money out, that's why you're saving it. Who gets the first cut and the biggest cut? No, your uncle. We all got the same uncle. He's called Sam. Now, Mitch, do you think taxes are going up or down? Right. In fact, everybody, Michael, do you think taxes are high now? The highest tax bracket is 39.6%. Do you think that's high? Okay, right, but we're in the United States. So, but in the United States, do you think that's a high rate?
I'm sorry, I said that backwards. Yeah, no, it's not. It's going very high.
Okay, right. And so here's my point. I want you all to know this because everybody contemporarily will tell you, Tony, yeah, taxes are high. You should know it, and I know it because we lived it. Okay, the rest of them in this room, no way. It's only they're the third lowest ratings right now, or percentage in the history of the United States. There's only been 2 other periods lower than it is right now. They've all been higher. So where do you think taxes are going to go? With knowing that there's an going to be $20 trillion deficit, and they keep spending. You hear these presidential elections. Where do you think taxes are going to go? They can only go up. So now I'm going to be your uncle. You're a farmer now. Booga booga. You're not in tile business. You're a farmer. Now I'm going to tax you. So do you want to be taxed on the seed or the harvest? Tony, which one is the answer?
The seed.
Right. The seed. Why? Because you pay on the seed. When you plant the seed, the tree grows. You got 50 apples I'm going to tax you on instead. You never want to pay taxes when your money's the biggest. And that's exactly what you're set up to do. They know it. They're waiting for it to be the biggest so they can take the biggest cut. Is that true or true? So that's number one. So your uncle is your partner with you. Oh, by the way, you don't even own it. Ain't that something? You keep giving your money away. Mitch just goes, come on, take it. Okay, so you keep giving it away. He thinks he owned it until tonight. You're only a beneficiary of it. And by the way, who's your second partner? Did you know you had another partner? So here's the truth. All of you that have 401ks or retirement accounts, you're only a beneficiary on it. That's all. And now you're finding out you're not even second online. You're third. Your second is what we talked about, Broker Joe and Broker Sue. And what we asked about it, doesn't Broker Joe and Broker Sue make money whether you make money or not? How devastating is that? They don't. So do they care about you? In fact, by the way, have you gotten any Christmas cards from them, Mitch? Might be a little pissed off. Am I right, Tony?
Mm-hmm.
See, these people are making money at your expense, whether you make money or not, and they don't care. And they make it every time you pay them. Am I right or right? They're happy campers. So then you come on list. So it's unbelievable. So I want to, and yes, try.
We bear all the risk.
Well, that's where I was going. So go ahead and do it.
No, we bear all the risk. That's why I just want to make sure you threw that in there.
Oh, thank you very much, Fred. So the final question is, who bears all the risk? Okay, so they make all the money. Who bears all the risk? And we said it in the film there. We did. You, the owner. So I want to get it straight. You give money every week or every month, every pay period. Uncle Sam takes the first and biggest cut. Then you're paying Broker Joe and Broker Sue. They make money, make money whether you do or not, and you're bearing all the risk. Does that make any sense to you, Mitch? Then why are you doing it? I don't know. Do you hear that answer, Tony? Everybody says, I don't know.
Well, there are some reasons or some approaches that you might give. For example, you're going to be in a different tax bracket when you retire.
Yeah.
So you're not at a 39% bracket, but you might be at a 28% bracket or perhaps a lower bracket.
Amen. Can I ask you a question?
Mhm.
What's better than tax-free?
No, nothing's better than tax.
Oh, okay, amen.
Right? But then there's another thing, and that is that the money that you put in there is not being taxed, so you're putting in a greater piece of that money.
And then you're subject to market loss, so you lose most of it too, right?
You're subject to market loss, but you're also subject to gain. So you could have a greater gain on that money that was not taxed.
Amen. So if we can show you the actual history of the world, of the United States and the stock market, and prove what you just said is absolutely true to the contrary, would you want to have the safety net?
No, but there are arguments for doing it
Oh.
initially.
There's an argument for everything.
Yeah, so, but what you're saying might be true, but there are different situations.
Absolutely. And none of them make sense
Mhm.
when you tell the truth.
Mhm.
See what Tony's doing right now? It's very good. He's like surfboarding, and we don't make anybody wrong. We just tell a different story and make them see it. So we give people choice.
Mhm.
Choices they didn't even know they had. You want to say something? I can feel it.
I kind of did. I was just, I wanted to know. People, a lot of people, I've heard a lot of people say that I might be in a lower, not what you don't know what I'm gonna say yet. Be in a lower tax bracket in retirement, but that just means that you're making less money. And I wonder,
That's correct.
why would you want to make less
That's
money
right.
in
No,
retirement?
you don't want to make less money.
Right.
It's usually the situation
That you do,
that
right.
you do make less
Yeah.
money in retirement.
Right.
So it's.
So what we teach people is make the most money and sheltered from taxes.
Mhm.
Boom,
Make more.
legally. So make more, pay less.
Mhm.
I'm cheap. I want the most value for my money. Who's cheap in here? Anybody? Good, you can keep listening then, because we're looking for cheap people. You get the point? Now, and we have fun at this thing because we expose what most people have never seen before. Yes, Trey.
The biggest thing that, I agree with Tony. However, the biggest thing that when you compare this to a 401k is if you get sick, that 401k isn't going to pay you out.
And they don't have any living benefits. There's no life insurance stats. See, it's a combination of what we're doing. So we take people's circumstances, and here's what we do. We tell people, fill out a CNA, a confidential needs analysis. We don't care about personal information, numbers, and all that crap, just the raw data. And what we do is run analysis for people. And here's an example of it. We believe that everybody should have 2 dates in their mind. You saw, all of you agreed to those 6 steps, right? But how many people really aren't doing all 6? Mostly anybody in this room aren't doing all those 6. You know it, and I know it. That's why you're here tonight. Boom. So what we try to do is make sure you get all the 6. And as Shane said, very appropriately, there's only 2 services we provide that fill up all those holes you got in that Swiss cheese. And so we show it. So we think that you ought to have 2 dates in mind all the time. If you don't have them in mind, shame on you, because you're not helping you or your family. Here's what we think. You all had to have a debt-free date. Shouldn't have any debt. Debt sucks. There's nothing good about it. You're paying somebody else for your hard-earned sweat equity. Am I right or right? Just checking. So have a debt-free date. Totally. When are you getting out of debt? When is it? You should have it, know it, see it. It should be a plan right in front of you. We supply that. Second thing, you should have a financial independent date. You should know exactly what you want to make, how much you're going to make, and for how long on your plan for your longevity, what you think. Am I right or right? So we make up what we call an FIP for people. Tony, can you tell them what that means? The FIP?
Financial independence.
There you go, financial independence plan. This happens to be his, okay? Truth is, 9 out of 10 of the people that we service don't spend any new money out of pocket. Why? Because they're already doing all the things, but just maybe a little inappropriate. So we sit with them and counsel them and move money from A to B. By the way, A stands for awful and B is bonita. Okay? And big. And but when in doubt, what are you supposed to do? Pick the big one. Okay? So we just show people how to move it. 9 out of 10. Most of our clients we're moving actually about $300 a month. In this case, this cost him money, $38 a month. Now the truth is, he's investing altogether $211.25 a month. But it only cost him $38 out of pocket because he was doing a lot of the same things that we just fixed for him, right? So in Ryan's plan right now for life insurance, he has $350,000. If he were to pay, God called him home, his brother's getting $350,000. I don't know why he didn't put mom or dad down, but he put down Shane, all these folks. Okay, that's Shane, and then he's got living benefits, critical, chronic, and terminal, over almost $600,000 in that area. So if he becomes, and then by the way, Here's the other thing that we didn't say. It's 16 different modalities. Alzheimer's, dementia, all the different things that the common occurrences you get are all covered. There's not a lot of companies that do that. It's only been in the United States for 10 years, by the way. And out of the 2,400 that Trey was mentioning to you, there's only about the 20, and we have about 6 that give all the best ones. That's pretty important. We rep for all of them, shopping for the best. So you got living benefits, and here's the kicker. At retirement, Tony, when he turns 66, he's able to access for the rest of his life $103,753 a year tax-free. As a scientist, as a master's degree person, he was making $38,000 for the state of Florida. Are you kidding me? Here, just doing what he was doing for $38 a month, he's going to have $103,000 for the rest of his life, tax-free. That's huge. Everybody get that? That's what we do. So we do the storage. Then here's what we do too. Because we're consumer advocates and we represent people. By the way, they cover stuff too. Like you say beef, but look what they do. Running out of money, they tell you exactly what we're telling you. The fees in your retirement plans are ridiculous. If you're 1% is the equivalent of 10 years of your retirement work over a lifetime. 1% is the equivalent of a 28% loss to you over the lifetime of your investment. And nobody appreciates that because you don't realize it. You don't know the math. We didn't know it either until we studied it, and we got blown away, and now we're just moving it for people. You saw those, the red line, blue line? What we tell you, $17 trillion right now. And by the way, the government's looking to nationalize your 401ks as we speak. And don't think they won't, because it matches the debt and they need to get the money somewhere. And the government always thinks they know better than you. And I can speak like that because I ran one. So if you run a government, you're qualified to speak. If you're not and you want an argument, come talk to me. Okay, run a government and tell me what you think. Okay, we can give you some facts. Hello, that's controversial because everybody's got an opinion. Well, show me. How about that? We're a show me company. How we doing? Boom. Okay, so we have answers, and it talks about, look at this one. It talks about nice red cars, but it also talks about retirement reality check. We have a retirement calculator that takes what you're doing right now and shows you when you're out of money, right? Yeah. It's great. It deals with the market loss, and we are very conservative in it, and everybody thinks they got enough. You start freaking out when you realize, oh man, I'm going to be out of money here. See, what we said, if you heard it, it pays for until he's passed away, for life, until he's 120, actually. I don't think he's going to cut 120 either.
121.
121? Okay, sorry. So we built the business out of this. You know, some of you are just, some of you not, but we'll show you this. We do build a business out of this because this is relatively new information for everybody. If you saw it, the IUL was only created in the year 2000, right? So we know this, and a bunch of us, guys that I've worked with 30 years ago, Lindsay, 30 years ago, they were all blessed. They were all very successful people that we knew each other. We weren't in each other's businesses. We were just in the same business. We used to travel the world together. Well, somehow we all just stayed in touch. And when the laws all changed to create what you're looking at, one or two of them were staying attention, and we called each other and said, did you know? Did you know? Did you know? So we all care for people. So you can't let people you care for and love not know this. We can. I got a sister that's dumber than the hedgehog. You know how many times I talked to her about this? Like, well, I'm afraid of change. Stay broke. Don't come. When you're broke, don't come to me. When the market crashes and you lost in 2008 and you still haven't recovered, you're just getting back on your feet and they got $1 million exploding, do not come to me because I ain't giving you mine. Not when I'm telling you the truth and you don't do anything about it. That's my sister. I love her dearly. Great family, and I ain't giving them crap. I'm giving them free advice now. How am I doing? I don't even like you, Steve. Well, I didn't ask you. No. So in any case, we build a business out of this. Now, for those that you might be interested, we'll show you what we're doing because it's pretty neat. We're building an agency. Right now, Michael, you work for an agency. Now, we do the same thing here, but you can be your own brokerage, so to speak, and not have to deal with a broker and get it. So this is, now in our debt business, you don't need a license to do that because that's a GPS, that's a software system. In the insurance side, you have to get a license. It's required by law in order to get paid. That's it. So we have a whole system that if you're interested, we'll show you what it is. But here's the bottom line. Go up to that screen right there, and I'll show you. As an example, right now, I mentioned to you earlier that the average person is dealing with $300 a month, all lost money. Like, for instance, Tony, one of the things I said to you before, I was alluding to taxes. You know what? Everybody gets a tax refund check, and they think that's normal. Some people think it's great. Oh, I got my tax refund check, and they celebrate. I go, well, you are a dumb butt. They go, what? Watch, Mitch, tax refund. Tax refund. You know what that means? You've overpaid. Now watch. Now, when you asked for your money back, did they give it back to you right away? No, took a month or two. Now he's getting quicker with the E stuff and everything. That's pretty good. But here's my question. Tony, when you get a tax refund check, how much interest is attached to the money that they send back to you?
0.
Zero. I like how he said zero. Say it again, Tony.
0.
Zero. Imagine being the zero in life. No, they gave me zero. Now, if you owed money to the government, could you get away with sending them zero? Oh, so why are we accepting that from them? See, we teach people how to make an adjustment under W-2 form that puts more money back in your pocket. I've not seen anything less than $100. I don't have any. The two famous lies. By the way, you're all liars. You all know that, right? Hello, Mitch. You ever lied before? Thank God. I thought he was going to say no. I'm going to say you're lying right now, boy. Okay. See, that's a bad trait. We all learn to lie. Lindsay, you ever lie? Yeah. Boom. Okay, all of it. So I'm not trying to point out our faults. I mean, we all have them. You know, we're all sinners. Who cares? So we'll get better. Here's the point. Where was I going with that, Ryan? I lost my thought. Yeah, tax refund. Thank you. Okay, but why was it about lying?
About overpaying and putting money back in our pocket.
Well, so we save about $100, and everybody gets real excited about that, thinking it's a good thing. We say no, it's not a good thing. We want. Oh, the two famous lies that everybody lies about is I don't have the money. I don't have money. You all used that one before at one point or another, and the other one is I don't have any time. You lying dog. Either way, you're lying. Want me to prove it to you, Mitch? See, you got time. It's just yours. It's what you choose to do with your time. Am I right or right? Absolutely. See, if you wanted to make it a priority, like you came tonight. As I understand it, you've been telling him, and all of a sudden you got me, and you said, well, all right, I'm coming tonight. Am I right or right? You're right. I hope you're enjoying yourself. Okay, good. Saying all the right things. Tony came because I dragged him. I was going to put a chain around his neck and throw him in the trunk. You didn't have a choice, right? It's your neighbor. See? But that's how that works, okay? You just got to have fun. People, I don't have the time or I don't have the money is a lie all the time. You all got money for what you wanted for. That's how you went into debt. Am I right or right? Yeah. So we don't put up with your lies. And you have your own thoughts. I'm going to exhaust you, Tony. You can never argue with me because I'm going to twist it right around and give it back to you. And I'm going to win, dadgummit. That's the way it is, okay? And you can fight, oh, I don't even like him. Yeah, because I'll give it right back. See, when you're telling the truth, you tell the truth. Am I right, Trey? Good stuff. So watch. We find $300 out of people's budget that they're completely blowing somewhere else, and middle America can't afford that. So we turn around and create this FIP for people and do it. When you do that, that's $3,600. If you get, we have a 90-day plan to get you to this part-time position called VP. You can still be part-time. So do the numbers, Ryan. 2 a month pays you, because it's the highest paid industry in the United States, $56,000. Sony, would $56,000 be a good part-time income for somebody? In this country, it's more than most people make full-time. There's only 4% of the United States population makes more than 100,000. You just got to help two people. If you're not helping 2 people a month, you're not even talking to people. In fact, you're a dodo. You're not doing anything. You're being a glom in life. Am I right, Trey? You're right. 2 people a month. That's all it takes. Okay. And there's plenty. And then watch people. You don't have to do this business, but everybody will refer you. Who wouldn't want to have tax-free income? If they don't, they're not. Let's walk away. See you later. Hey, is there a lot of? Listen. You know, Einstein, was it Einstein? I love Einstein. Here's what he also said, Tony. Here's a quote. The only difference between genius and stupidity is that genius has its limits. Boom! See, if people choose to be stupid about things, you can't fix stupid. Am I right or right? So if they don't do what's in your best interest and it's common sense, run away. I run away from people. I don't want time out. I got to go. I just leave. I don't talk to them. Hello, is that okay? You're so bold. No, we're just telling the truth. So here's the deal. Now, Mitch, if you got employees, we'll go put 2 or 3 of them in here with you in the business. Since you're laying tile, they all need benefits. Do the right thing. Get rid of the 401ks. We'll convert it all for you tomorrow. Okay, when you see it, black and white, A and B. So watch. If you put 3, is it 3 people, right, Ryan?
2.
Oh, you just no,
3, yeah.
3 people all doing the same thing. That'd be a total of 8 transactions in a month. That's all. You have a financial interest. Every time they do something, you get paid. Just like right now, every time you get a tile job and they're laying it, you're getting paid. You pay them, you keep the profit. Am I right? Right. It's called an override. Every business runs the same way. Anybody telling you different, they're lying. Come see me. Okay, I just tell you like it is. Okay, that's the bottom line. And they can't argue with the one thing you said. So, go ahead, have 3 people go do 2 apiece. you immediately make $121,000 a year. That's more than most people are making right now in this country, and you have no liabilities. You don't have to pay for office rent. You don't have to pay for a secretary. You don't pay for accounting. We do it all for you. You get your offices, back office. That's for people that are interested in the business. That's pretty good dang money. You know what? That's why Shane started out and he said, and we do have everywhere. We have doctors, lawyers, doing this, chiropractors, ophthalmologists. We also have truck drivers. Where can you go get an eclectic group of people like that that come from professions and educational backgrounds with no education in the same business doing the same thing? I love it. It's called America. Okay? That's exactly why I love this business. Okay? And this flies in the face of most people's what they think is common sense. Bull. You know, they think they have to go get a big, I got degrees. Guess what? It didn't get me anything besides a headache. Okay? Boom. They were blessed. They got out of college and didn't have a debt. You heard that. How many other kids got debt? That newspaper will tell you the story right there. So we beg to differ with you. I know it's controversial, Tony, because we throw a lot of stuff at people that's traditional. Traditional doesn't mean it's right. My mother couldn't cook. She burned water. Imagine that. Okay? And she did things out of tradition all the time. I was going to tell a whole story, but I won't go through that. Tradition doesn't mean it's right. It just means it has been done over and over and over again. And you heard the old story that if you keep doing the same thing over and over again and expect different results, that's the definition of insanity. You can't fix it. You didn't know this was here, neither did we, until the laws changed and several partners of mine from years ago got to get all wealthy millionaires that came out of retirement just to make a difference in society. And by the way, PBS just did a study on us. They just filmed us out there. About 108 million people are going to see this on PBS because of living benefits. They know it's a new crusade. And they filmed, we're one of the only